As we sit here this morning, I am reminded about one of the most interesting weekends which we have just gone through. After the Indian markets closed on Friday, two developments, major developments have happened, and I'm sure a lot of you must be busy on your iPhones and Blackberries. The US jobs report, which has turned out to be stunningly positive. As I understand, if we take the last 3 months, which is one quarter, the highest growth in jobs in 17 years, and the implications of that in the context of assets, particularly in India, for this conference. And the second, of course, 5 saal Kejriwal, which seems to be what the exit polls are saying. So both these are major developments, friends, between the time we close markets on Friday and the time we open on Monday. So we are in for very exciting times. Let's see how the markets open. But it's in this context that I just wanted to step back and have a perspective of how I see the situation in the Indian context, looking at what's happening around the world. First, the European QE, which was the one major event which happened in January, and the sense I was in Davos, and the sense I got is this may be something which will help Europe muddle along, subject to Greece and what happens around that. But it ensures that there is enough liquidity out there and a weaker euro. Most people seem to be giving me a feel that we are heading for a 1:1 parity on the euro dollar. And from a level of 120, the euro is down to about 113. And sliding pretty fast. So that is one thing. And then along with that, you're seeing an amazing drop in yields on all highly rated European sovereigns, the German bond, whatever is the exact, but somewhere around 0.3 for a 10-year paper. And it just sort of surprises me that how will capital, and I remember Bill Grove's statement, how will capitalism work if interest rates in the world are zero? So it's a question which does come to my mind as you look at the European situation. And then, of course, before that, we've had this big correction in oil, and which, again, the sense from Davos was that finally oil, by end of the year, should settle in the 60s to 70s for the Brent. Again, wide debate on that. There is a theory which says it may first go to 30 and then to 70. But from 48 to 58 in a period of less than 2 weeks is what we have seen. So oil and all commodities as an asset class, generally weaker, but may stabilize in the 60s to 70s, particularly in the context of oil. That's the sense I have picked up. On the other hand, if you moved east, the big question is, of course, immediately Middle East, how that goes, and then on to Japan and China. My sense about China is, and I've been talking to a few people, is that it's slowing down much faster. And for people from Asia, they may have perspective on this, but the Chinese story seems to be slowing down much faster than what official data reflects. And I was just looking at one statistic, which is steel. The global steel production is 1,600 million tons, or capacity. China has 50% of the world capacity in steel. And India, on the other hand, has 80 million versus China's 800 million tons capacity. And we can see some of the early signs about what this excess capacity in steel in the world is doing, including in terms of India being once upon a time a net exporter of iron ore and steel to becoming a net importer at this stage of both iron ore and steel. So a very significant change is taking place around that. So in this context of effectively one engine world, which is the US, and what does it do to our future in India? Another interesting aspect about US is that 10 years ago, this one engine was 35% of global GDP. It is now 22%. So US contribution in terms of weightage to global GDP has now reduced from a level of 35% to 22%. And most of that, obviously, that space has been taken up by China. So a stronger US growth, but a lower weightage versus a slower China, a sluggish Europe and Japan, and challenges in the Middle East, give you a overall perspective, which is that the world continues to be reasonably deflationary, despite US being the bright spot. So what does this mean for India? Number one, I believe that as we go into 2015, till Friday evening, my view was that the Indian economy, from a fundamental growth and monetary policy point of view, including interest rates, my view was Indian GDP growing at about 5.3% as of March 2015 for the year ending March 2015. And I'm going by old data. The new data is something I still cannot fully understand. So 5.3% for March 15. And I would frankly be delighted if India touched 6% next year. I am more of the view of around 5.8% GDP growth for 2016. And we are lucky if we get to 6%. Therefore, my view on growth is more moderate. My view on macroeconomic stability for India is much more positive. I see a flat current account for March 2016, give or take plus minus 0.5% of GDP. Therefore, much more stable current account. And that brings me to the other point, which my view has got a little more moderated between Friday and today, which is on monetary policy. I was strongly of the view that by end of calendar 2015, RBI repo rate would be down to 7% from the current level of 7.75, which would be a total of 100 basis points reduction. But I know the RBI has a very high focus on what's happening globally, particularly the United States. And therefore, if the US jobs data is so much stronger and we are likely to see a potentially faster movement on US interest rates, I would be more of the camp that the speed at which rates drop would be slower. Therefore, interest rate drop in India, which one was expecting another 75 basis points between now and December, I would moderate it more to, if we are lucky, 50 basis points. But Dr. Rajan, and I think you must give credit to the way they have approached this whole business about interest rates, is I think the path is very clearly laid down. And what does this mean for the economy? It means more hard work. It means a much more gradual increase in growth rates. It is not a hockey stick, and a phrase which I've always loved to say, that this is truly a marathon, not a sprint. And therefore, the curve and the gradient of the growth will be more moderate, but I believe far more sustainable, because we will do the right things. We will not play to the gallery. We will and frankly, we have seen a significantly more purist RBI. Therefore, at a time when the rest of the central banks in the world are ready to do more, to use the cricketing terminology, more cross-batted shots, the Indian RBI is playing a more purist, traditional game. So, but I am more bullish long-term. I feel much better building businesses in an environment where there is greater predictability and stability of the macroeconomic fundamentals. And the biggest challenge, as I see it, is in this context. How do we get investments going up? What really takes the Indian investment engine up? And frankly, that's where the model is broken. Historically, this was being done primarily by government. The government gave up the space and said, we want a model which was the public-private partnership model. That model, friends, is frankly failed for a variety of reasons. And the outcome today is many private players in the public-private partnership who had a great ability to manage the Indian system and the complexity of it don't have too much equity. And for a change, the purist RBI is going back to fundamentals, that if there is stress, the equity owner takes the first pain. Only after that, the lender takes the pain. So if that is the rules, the new rules of the game, as we are seeing in the Indian context, where is private sector equity, particularly from the Indian promoters, who were the big players on Indian infrastructure? Where is that equity going to come from? And frankly, if we really go to kickstart Indian investment, it has to be a combination of the government companies doing a lot more on the one hand, and a new model for the private sector. And I don't have an easy answer, but one model which I think we need to start thinking about is the model which has worked in a completely different sector, which is the Indian digital and technology sector, where promoters who start companies in the technology and digital sector are ready to dilute their equity much faster and are ready to grow the company with smaller skin in the game, backed by significant institutional money. And do we have, and I would love to believe that there are enough people in the professional class in India who would be ready to take that bet to work towards a new investment and growth model, including in infrastructure sector, which is professional entrepreneurs with relatively smaller skins in the game, but ready to be backed by institutional money. This is a whole different game. I think the model will take time to evolve. So if you move to a belief that this time around in the Indian economy, people who have made mistakes will have to pay a price in terms of having lost a lot of their equity. And banks having to take tougher calls on how they deal with some of these companies, combined with the fact that, again, in the context of the financial sector, that restructuring will not be allowed after 31st of March. So I see a slug of restructuring coming from Indian banks in their last opportunity, which is between now and 31st of March. And thereafter, the day of reckoning hopefully comes where you have to bite the bullet and take the pain through the balance sheets over the next 1 year. And finally, a purist method of distress resolution coming in the system, which I think will play out over the next 9 to 12 months as banks begin to recognize reality. My view is it will mean a significant recognition and realization of the reality which most of us have been aware of, but we're hoping that some magic wand or kicking the can into the future will solve it or wish it away. Based on this purist RBI approach to this solution, I think we are heading for a time where recognition and realization is here in front of us. What it means is very shortly, and in the short run, I think most PSU banks who have holding above 50, well above 50%, will use the opportunity, since all of you are so gracious in providing equity easily, to come to the market, and they are cheap. So you will be happy to, the arbitrage between private sector and public sector is huge. So they will be, I'm pretty confident they will be able to raise money from the public markets. So the issue is not 12 to 18 months. We have to ask the question, what happens thereafter? I mean, when you reach the 51% magic number, and are we, the country, the Indian polity, ready to bite that bullet? And frankly, this creation of a national asset management company is talked about, but frankly, my view is the very simple solution is let companies raise capital, drop the ownership of the government well below 51, and have a hurdle, whether it's 33, 26, whatever it is, but let them free. In the context of Indian polity, and that is where the symbolism of Delhi elections matters, will it be feasible for Indian polity, because this requires a legislative change, will it be feasible for Indian polity to take that tough call of really freeing up public sector banks? And frankly, the most outstanding example of something like this, which was never a public sector bank, is think about is, say, a bank like Axis. I mean, government ownership is 25, 26%, including LIC and everything, but it's a private sector bank. So why can't we do that, something like that, with all of Indian public sector, which is 75% of Indian banking? So I am more conservative in believing that, and therefore of the view that this is very tough in the context of Indian polity, but I know for a fact, in some of my talks with government, that the intent to do something significant is there. The question is whether this happens or no, whether we see Indian public sector banks truly unleashed to a new era in Indian banking. And based on that, to talk more specifically about public sector and private sector, you could take your calls which side to bet. So moving beyond that, friends, in terms of the more immediate in the Indian financial sector, I think for players who are looking at building over the next 5 to 10 years, I genuinely believe that India is a place which is looking extremely positive for a 5 to 10 year marathon. And it goes back to something which I deeply believe in the context of the financial sector. You really have two parts of the financial intermediation model. One is what you call as the saver-borrower model, which is intermediation between a traditional saver and a borrower, which is the typical banking model. It is possible for institutions to grow in this space at what I believe 2 times nominal GDP. And I'm using the words carefully, nominal GDP, which is real plus inflation, which currently looks like 11, 12, and it is possible for players to grow at a significantly faster clip than nominal GDP, and depends on the nature of the institution, but 1.5 to 2 times seems sustainable without having problems on the asset quality. The second aspect is the second intermediation model, which is where many of us also play in, is what I call as the investor-issuer intermediation. And we are seeing the development of the markets on the investor-issuer intermediation actually grow much faster, both in equity markets, in debt markets, asset management, securities, debt capital markets. The most interesting aspect which I'm seeing is development of the debt capital markets, which is again back to investor-issuer model, where number of large corporates who were traditional banking borrowers have moved to the debt markets. Therefore, a lot of the spreads of banks which are dependent on wholesale lending disproportionately will be disintermediated to the wholesale debt markets. And unless players are able to play that and manage the risks of credit, interest rate and liquidity, they will face the challenges to move into that. But for players who can move into the intermediation game, in addition to the saver-borrower model, what I call as the investor-issuer model, financial sector in India is one of the finest places to be over the next, hopefully, 5 to 10 years. And in a way, as the gradient gets more gradual, it gives you a lot more time to be building sustainably rather than doing hit and run. So with that, friends, I will now sum up and open it for Q&A with just a very strong belief that as I think about our journey as Kotak in India over last close to 30 years now, which has been very exciting. The journey of the marathon over the next 10 years from the perspective of Indian financial sector, of which we are a player, is looking even more exciting for the next 10-year marathon. Thank you very much, ladies and gentlemen. I'm happy to take questions and answers.